The Indian rupee is in trouble. It hit a new all-time low against the US dollar at the end of January 2025. This decline is concerning for the Indian economy and its people. The rupee's fall isn't just a blip, it's been on a downward trend for years. Since early 2021, the rupee has been steadily losing ground. This recent drop is a significant acceleration of that trend. The situation is alarming. The rupee was the worst performing Asian currency against the US dollar in January. It fell by 1.1% in just 1 month. This weakness is particularly concerning because other Asian currencies actually gained value against the dollar in January. The rupee's fall is a clear signal. It suggests that the Indian economy is facing serious challenges. These challenges need to be addressed urgently to prevent further economic hardship. Yes, the US dollar is strong, but that's not the only reason the rupee is struggling. Several factors within India are contributing to the rupee's decline. One major issue is India's heavy reliance on imports. India imports more than it exports. This trade imbalance puts constant pressure on the rupee. When the rupee falls, imports become more expensive. This situation fuels inflation and hurts Indian consumers. Another factor is slowing economic growth. India's GDP growth has been decelerating in recent quarters. This slowdown makes India less attractive to foreign investors. When investors pull their money out of India, it puts further downward pressure on the rupee. India relies heavily on imports for essential goods. Everything from crude oil to electronic components flows into the country. A weaker rupee makes these imports significantly more expensive. This price increase has a ripple effect throughout the entire economy. Businesses face higher costs for raw materials and energy. These increased costs are often passed on to consumers in the form of higher prices. For everyday Indians, the falling rupee means a lower standard of living. Their hard-earned rupees simply don't buy as much as they used to. This situation is particularly difficult for low-income households. They spend a larger proportion of their income on essentials like food and fuel. The rising cost of these necessities can be devastating for families already struggling to make ends meet. The falling rupee has made foreign investors nervous. They see a currency in decline and an economy facing headwinds. This lack of confidence has led to a significant outflow of capital from India. Since the start of 2025, over $9 billion has been pulled out of Indian investments. This capital flight has a direct impact on the Indian stock market. The Sensex, India's benchmark stock index, has been on a downward slide for the past 4 months. It has fallen approximately 10% from its peak in September 2024. This decline reflects the growing concerns about the Indian economy and the rupee's future. The falling stock market further erodes investor confidence. It creates a vicious cycle where a weaker rupee leads to capital flight, which in turn pushes the stock market lower. This downward spiral can be difficult to reverse without decisive action. Section 5. The GDP slowdown. A worrying trend emerges. India's economic engine, once a powerhouse of growth, is showing signs of sputtering. GDP growth, while still positive, has been on a steady decline for the past 3 quarters. This slowdown is a major concern for policymakers and a clear warning sign about the health of the Indian economy. In the third quarter of 2023, India's GDP grew by a robust 8.6%. However, growth slowed to 7.8% in the first quarter of 2024, and further decelerated to 6.7% in the second quarter. By the third quarter of 2024, GDP growth had slumped to a worrying 5.4%. This trend of slowing growth is a far cry from India's ambitious targets of 6.5 to 6.8% for both 2024 and 2025. The slowdown is a result of several factors, including weakening global demand, high inflation, and uncertainty in the global economic outlook. The falling rupee is also contributing to the slowdown by making imports more expensive and putting pressure on businesses. Section 6. Trade deficits, a persistent drain on the economy. India has a long-standing problem with trade deficits. For the past 5 years, the country has consistently imported more than it exports. This imbalance puts constant pressure on the rupee and drains valuable foreign exchange reserves. The trade deficit has been widening in recent months, reaching a concerning $22 billion in December 2024. This widening gap is a clear indication that India is struggling to compete in the global marketplace. The falling rupee exacerbates the problem by making exports more expensive and less competitive. The trade deficit is a symptom of deeper structural issues within the Indian economy. These issues include a lack of diversification in exports, over-reliance on imported energy, and bureaucratic hurdles that hinder businesses from operating efficiently. Addressing these underlying problems is crucial to reducing the trade deficit and stabilizing the rupee. Section 7. The inflation bite, eroding purchasing power. Inflation is a silent thief, steadily eroding the purchasing power of ordinary citizens. In India, inflation has been on a relentless upward march, exceeding the Reserve Bank of India's target of 4%. This rising cost of living is causing hardship for millions of Indians and fueling social unrest. In December 2024, inflation hit a worrisome 5.22%. This overall figure masks even more concerning trends in specific sectors. Food inflation, a key indicator of affordability for low-income households, soared to a staggering 8.4% in December 2024. This alarming rise in food prices means that basic staples like rice, lentils, and vegetables are becoming increasingly out of reach for many families. The falling rupee is a key driver of inflation. As the rupee weakens, imported goods, including essential commodities like crude oil and edible oils, become more expensive. This price increase ripples through the economy, pushing up the cost of transportation, manufacturing, and ultimately consumer goods. Section 8. Looming threats, tariffs, and global uncertainty. The global economic landscape is fraught with uncertainty. Trade tensions, geopolitical conflicts, and the lingering effects of the COVID-19 pandemic continue to cast a shadow over global growth. For India, these external threats could further exacerbate the rupee's woes. One specific threat comes from potential tariffs on imports to the United States. The former US President, Donald Trump, has hinted at reimposing tariffs on goods from countries like India. Such a move would be a significant blow to Indian exporters and could further widen the trade deficit, putting additional downward pressure on the rupee. The global economic slowdown is another major concern. As major economies like the US and Europe experience slowing growth, demand for Indian exports is likely to weaken. This reduced demand could further harm India's trade balance and put additional pressure on the already struggling rupee. Section 9. Charting a course, policy actions for stability. The Indian economy is at a crossroads. The falling rupee, coupled with slowing growth, rising inflation, and a widening trade deficit, presents a complex set of challenges for policymakers. Addressing these issues requires a comprehensive and coordinated approach. The Reserve Bank of India can play a crucial role in stabilizing the rupee. Raising interest rates can make holding rupees more attractive to foreign investors, stemming the flow of capital flight. However, this approach must be balanced with the need to support economic growth. Raising interest rates too aggressively could stifle investment and further slow the economy. The government also has a critical role to play. Structural reforms aimed at improving ease of doing business, promoting exports, and attracting foreign investment are crucial for long-term economic stability. These reforms should focus on reducing bureaucratic hurdles, improving infrastructure, and creating a more investor-friendly environment. Addressing the trade deficit requires a multi-pronged strategy. This strategy should include efforts to diversify export markets, reduce reliance on imported energy, and promote domestic manufacturing. Investing in renewable energy sources, such as solar and wind power, can help reduce India's dependence on imported oil and strengthen its energy security.
So hit that subscribe button, ring the bell for notifications, and let's turn the page on a new adventure together. Get ready to experience books like never before, only on VBook 360. Like, comment, and share to support the channel and keep the video magic alive. Thank you for stopping by. And remember, every video has a story, and every story deserves to be shared. See you in the next video.